Hello, I'm Romi Savova, CEO of PensionBee. It is a pleasure to welcome you to our preliminary results presentation. For those of you who are new to the PensionBee story, we are a leading online pension provider in the UK. We exist to make pensions simple so that everyone can look forward to a happy retirement. We enable our customers to combine their pensions into one new online plan with money managed by the world's largest asset managers. We aspire to build a lifetime relationship with our customers, generating predictable and scalable revenue streams for our company and for our investors. Many of you will have joined us for our trading update in January, and so will be familiar with the excellent results we delivered for the 2021 financial year. In addition to a brief recap of those results, which saw us achieving triple-digit revenue growth, we will update on our strategic positioning for 2022. First, I will provide an update on the market and competitive environment, sharing some insights about market size from the Office for National Statistics and our performance in the pension consolidation market relative to platforms and robo-advisors. My colleague Jasper, our Chief Marketing Officer, will then elaborate on our customer acquisition plans, while our Chief Design Officer, Matt, will demonstrate our pension-related product priorities for the first half of 2022. Our Chief Technology Officer, Jonathan, will provide an update on our technology estate. Finally, our Chief Financial Officer, Christoph, will share some more detailed financial information that illustrates our excellent retention rate, our cohort growth, and the resilience of our revenue, which is a core feature of our business model alongside our excellent growth prospects. Turning to a recap of our financial results for 2021, our assets under administration increased to £2.6 billion, reflecting a compound annual growth rate of about 100%. That is, a doubling in size every year for the period since 2018. Our invested customer base exceeded 117,000, and we maintain a healthy pipeline of over 650,000 registered customers, underscoring the growth story of PensionBee. Thanks to our predictable revenue model and high retention rate of over 95%, the growth in assets has translated into similar growth in revenue. Our annual run rate revenue increased to £16 million. Our revenue for the year increased to £13 million, reflecting a growth rate in excess of 100%. One of the core reasons our business is able to scale so rapidly is the sheer size of the market opportunity in the UK. In January 2022, the Office for National Statistics posted an update on pension wealth in Great Britain, confirming that the overall defined contribution pension market stood at £1 trillion over the 2018 to 2020 period. Importantly, the ONS now provides one consolidated and detailed data extract to allow us to quantify the size of the pension consolidation market opportunity for PensionBee, which consists of the primary types of pensions transferred by our customers to the PensionBee personal pension, that is, preserved defined contribution pensions and active personal pensions. Based on the ONS market size estimates in the 2018 to 2020 period, there was over £700 billion in assets within the pension consolidation market. While PensionBee continues to grow rapidly, as at the end of 2021, it still only held 0.4% market share, leaving ample opportunity for further growth. Within this enormous target market, PensionBee's customer offering continues to resonate with consumers. The latest competitive market data from Boring Money, which assesses the quality of prominent platforms and robo-advisors, shows that PensionBee's quality of digital experience, customer service, and overall value for money is substantially above those of the average competitor. Indeed, PensionBee scores highly owing to the unique nature of its online pension consolidation offering, which is differentiated to those of other personal pension providers. In recognition of our differentiated customer offering, we received 5 Boring Money Awards in early 2022, including overall Best Buy for pensions. Our differentiated offering is well recognized in the consumer market, as demonstrated by the growing brand awareness of PensionBee. Our prompted brand awareness now stands at about 25%, demonstrating a healthy year-on-year increase of 44%. While we continue to make strides through our marketing activities, there is still ample opportunity for us to continue growing into a household name with brand awareness in the 80s. Of course, when it comes to growth, we seek to demonstrate our competitive advantage through results. Growth figures for AUA and customers continue to indicate that PensionBee is growing substantially more quickly than platform and robo-advisor peers. You will now hear from our CMO, Jasper Martins, who will expand on our strategy to maintain this excellent growth momentum.
Thank you, Romi. Hi, I am Jasper, CMO at PensionBee. I'm excited to share our customer acquisition plans for the year. PensionBee's marketing strategy in 2022 will largely be a continuation of what we did in 2021, alongside some extra activities where we have identified opportunities to effectively expand our reach. There are 3 key pillars for PensionBee's marketing strategy for 2022. 1. Accelerate our customer growth and marketing spend while monitoring the cost per invested customer. Cost per invested customer will rise in the first half of this year as we accelerate spend rapidly and subsequently decline towards the end of the year as we reap the benefits of the growth in invested customers. We will use our top 3 channels: TV, out of home, and paid search. And with the help of our new data platform, we will optimize within these channels and between them. 2. Broadening our customer appeal even more with specific product marketing campaigns. Earlier, Romi pointed out that the addressable market for PensionBee in the UK is vast. At the same time, PensionBee's product is designed to appeal to a broad audience. Whether you're 18 or 80, PensionBee could be your new pension provider. Product innovations such as our mainstream fossil fuel-free pension and easy contributions through open banking technology have paved the way for us to penetrate further into the pension consolidation market, attracting eco-conscious consolidators and self-employed individuals. Highlighting these specific innovations will make PensionBee irresistible for an even bigger audience, thereby driving customer growth. And 3, building trust and customer reach through a strong media presence and our educational campaigns. With our own in-house press office, we work with journalists, influencers, and pension experts. It's one of the best ways to build a trustworthy brand and reach as many customers cost-effectively as we possibly can. We are increasingly introducing more educational content campaigns, far beyond blogs and guides. 2 great examples are Pension Confident podcast and our Pension Academy video series with Patricia Bright, reaching thousands of extra pension savers who want to engage with pensions in a simple manner. With 2022 off to an excellent start in growing new customers, we're looking forward to implementing our plan for the rest of the year. I would now like to hand over to my colleague Matt, our Chief Design Officer, who will walk you through our product plans.
Thank you, Jasper. Hello, I'm Matt, PensionBee's CDO, and I'm looking forward to showing you some of the exciting new features we're developing in 2022. Product and design at PensionBee continues to stay at the industry forefront. By developing the features our customers want, in line with our business objectives, we've been able to continue to grow our customer base, increasing the amount customers are saving and improving efficiency, keeping our customers happy and our retention strong. A particular focus for PensionBee has been to grow our customer base of over 50s. We've recently launched in-app withdrawals, a first of its kind feature in the UK, with the aim of attracting customers with larger pension pots and therefore AUA. After making the customer aware of important factors associated with withdrawing from their pension, we present them with an overview of their available funds and the ability to withdraw from their tax-free and/or taxable cash as a one-off payment or as regular income. After ensuring they understand the risks involved in drawdown, they simply enter their bank account details and confirm. In addition to growing our customer base, we're growing our share of wallet. To that end, we're introducing relevant and contextual content based on customer actions and profiles into our products. By drip feeding targeted, relevant content, we can help people manage their pension at the same time as improving their financial literacy in line with our vision and growing AUA through increased contributions, alongside open banking and transfer of additional pensions to PensionBee. We've also prioritised features that provide scalability through reduced friction at points traditionally requiring manual intervention via the customer services team. By empowering customers to self-serve, we are reducing the time it takes them to complete tasks without requiring exponentially more staff members to support them with our growing functionality. Specifically, we've redesigned the top-level view customers see within the product to provide them with an improved at-a-glance understanding of their PensionBee pension. They will be able to see key information like the amounts they are projected to have at retirement and their plan's performance alongside their pension balance. We're providing an overview and breakdown of their pension, including all types of money coming into or out of their account. These figures can be filtered by timescale, including by tax year, for ease when filing end-of-year accounts. We've revised our product's information architecture in response to our customers' feedback to make finding key information easier. And we're improving our customers' understanding of their pension by surfacing more of the underlying factors that affect it, such as the types of industries companies invest in. These improvements are expected to reduce some of our top inbound queries, reducing the need to answer emails, live chats, and phone calls, while delighting our customers with engaging and informative insights into their investments. Now I'll hand over to our Chief Technology Officer, Jonathan, for a technology update.
Hello, I'm Jonathan, PensionBee's CTO. It's very nice to be speaking with you today, and thank you, Matt, for taking us through the plans for our product. Technology reaches into the heart of all aspects of PensionBee's business. The technology strategy for 2022 is designed to continue underpinning the business's growth trajectory and provide the capabilities we need for expansion. To that end, we have 4 main areas of focus for the year ahead. The first area is scalability. In order to support the company's growth, we're ensuring that our technology is prepared to support 1 million customers and beyond. We're making investments in scale testing, architecture, infrastructure optimization, and other areas that will continue to take advantage of the global cloud platforms PensionBee is built on. In addition, our data platform will be increasingly important as a capability for the business as it grows, used across multiple departments to improve analysis, decision-making, and budget allocation. The second area of focus is increasing our operational leverage through continued investments in automation. The 2 graphs on the right-hand side of the slide show 2 different ways that we look at the effect of automation on the business's productivity. We measure both the ratio of invested customers to average employees over a year, and also the commonly used ratio of revenue to average employee count. On both measures, our productivity is continuing to increase, and we're pursuing further investments in process automation to help us exceed £100,000 of revenue per employee. We're putting a lot of work into enabling pension transfers to proceed without requiring any human actions, as it is hugely beneficial for productivity. We're also investing in tooling to make our software engineers more productive, such as taking advantage of Salesforce's new SFDX toolkit. The third area we're looking at is the ongoing strengthening of our information security management system and operational processes. We were certified to the ISO 27001 Information Security Standard in January 2021 and completed our first surveillance audit in November. We're now investing in the tools and business processes necessary to ensure that secure operations and effective service management continue as we grow the customer base and the size of the team. This is building on a solid track record of operational performance. For example, our technology platform has exceeded our SLA of 99.9% uptime over 2021, and we have continued to run all of our infrastructure on public cloud providers. Finally, our fourth area of focus is our technology team. In a very competitive environment for technical talent, we're investing in training to ensure that team members grow personally and professionally, helping PensionBee to attract, develop, and retain exceptional talent. In summary, effective deployment of our technology is a core competitive advantage, and continued investments in our scalability, automation, security, and team will ideally position us for further growth. Thank you for your attention, and I'll now pass over to our Chief Financial Officer, Christoph, to take you through our finances.
Hello, I'm Christoph, and a warm welcome to the financial parts of our preliminary results presentation. We continued to execute on our growth story in 2021 and delivered strong asset growth to £2.6 billion of AUA. The AUA growth is driven by disciplined new customer acquisition and retention and growth of existing customer cohorts. Particularly retention and growth of existing customer cohorts is key to generating lifetime value on the back of embedded growth, which fundamentally is recurring and compounding in nature over time. The layer charts on the left-hand side visually shows PensionBee's AUA growth drivers. In addition to new customer acquisition, which is shown as the very top dark orange layer, lifetime value generation of existing customer cohorts are evident by the layers beneath, which we continue to retain and grow. Particularly, the retention rate is crucially important to continue generating lifetime value over time. As you can see on the right-hand side of the page, we are pleased to report a customer retention rate of close to 97% for 2021, which in fact has also improved over the last few years. In summary, generating lifetime value on the back of recurring and compounding asset growth for existing customer cohorts is evident in first, a high customer retention rate of circa 97%, which we show on this page, and second, continuous net inflows across all cohorts, which we will cover next. As communicated during our January trading update, we have grown our AUA base primarily with net flows from new and existing customers. We will report on new customer growth for the first quarter in April, but we are very pleased with the start of the year. For 2022, we expect to enjoy the fruits of new customer growth and also growth from existing customers. Today, we wanted to give further insights into the net flows from existing customers, which was £226 million over 2021, and is circled in red on the left-hand side chart. On the right-hand side, we visualized cumulative net flows, excluding market growth, by customer cohorts in a stacked bar chart, and we show cumulative market growth separately at the top. The intention of this visualization is to drill down into the sources of the £226 million of existing customer growth, as shown in the turquoise dotted box in the right-hand side charts. The £226 million of net inflows are the sum of net inflows across the various customer cohorts. The point to note is that all customer cohorts delivered positive net inflows in 2021, even the very early cohorts acquired in 2016, 2017, and 2018. Again, for the avoidance of doubt, this does not include market growth, which is captured separately at the top of the chart. Seeing positive net inflows across all cohorts is a powerful point, since it is evidence of our ability to generate lifetime value, as we not only retain existing cohorts at a high retention rate of circa 97%, but also grow them via continuously receiving consolidation and contribution. Another consequence of this is that an ever-growing proportion of our AOA is already available from prior years' cohorts. This generates a predictable asset base and de-risks future AOA and recurring revenue growth. In conclusion, generating lifetime value on the back of recurring and compounding asset growth from existing customer cohorts is evident in first, high customer retention rate of circa 97%, which we showed on the previous page, and second, continuous net inflows across all cohorts, which we covered on this page. We have turned asset growth into recurring and predictable revenue thanks to our resilient contractual gross revenue margin, which remained at 69 basis points. From a cost-based perspective, we have demonstrated operating leverage in 2021 thanks to the scalability of the technology platform, and we have improved both profitability metrics in 2021. As already communicated in the past, we are guiding towards adjusted EBITDA profitability by the months of December 2023 and adjusted EBITDA before marketing profitability by the months of December 2022. In conclusion, we have converted asset growth into revenue growth thanks to the resilient contractual gross revenue margin, and we have generated operating leverage for the year with continued margin improvement expected for 2022. The majority of proceeds we raised during the IPO have been earmarked on marketing spend, and therefore a close monitoring of that spend is critical, particularly as we expect to spend 17 to 20 million pounds in marketing in 2022. We will continue to invest in marketing and customer acquisitions throughout 2022, and we anticipate that marketing spend will be weighted towards the first half of this year, with cumulative CPIC declining strongly towards the end of the year, ensuring that annual CPIC remained within the target threshold. In summary, we utilize a methodological approach to marketing investment to ensure healthy growth, and we grew in a cost-disciplined way in 2021, and we continue to execute on our growth strategy in 2022. Customer acquisition costs are compared to the lifetime value to ensure we deploy marketing capital with an attractive return profile. The illustrative unit economics of the return over cost calculation with simplified assumption indicates that PensionBee deploys marketing capital with attractive returns of mid to high single-digit return multiples. I will now hand back to Romi to cover guidance and further updates.
Thank you very much, Christoph. I am pleased to confirm our medium-term and 2022 guidance. It would be remiss not to mention the impact Russia's invasion of Ukraine is having on the markets and on the world more generally. Like all companies, we will continue to monitor the situation. Our own exposure to Russia in terms of investments is minimal, in fact, rounding down to 0%. However, broader market volatility will impact AUA. It is still relatively early in the year, and our new customer growth since the start of the year has been exceptionally strong, but we will keep a watchful eye and update further if there is reason to do so. I'm also pleased to announce that we will make a further announcement regarding the transition to the premium segment of the London Stock Exchange in April. Thank you for taking the time to join our presentation today.
Well, thank you for that run through, and now we'll move over to Q&A. First one here, do you have plans to expand beyond the UK market?
Thank you very much for that question. It's a really important one because one of the things that makes PensionBee so different from other business opportunities is the size of the market within the UK itself. Defined contribution pensions has been rising since 2012 owing to government reforms for the automatic enrollment of individuals into workplace pensions. And as a result of that, the total asset pool within defined contributions pension stands at around £1 trillion. And our own target market within that is over £700 billion. And so within the UK, there is already an enormous opportunity for us to continue pursuing. And even though we've grown exceptionally rapidly, roughly doubling in size every year, we are still less than 0.5% of our target market here in the UK. And so first and foremost, we seek to continue growing that market share further and becoming a top 5 or top 10 player within this market before we complicate our business operations with the regulators of other jurisdictions outside of the country.
Ample to be getting on with. Excellent. Okay, this one around fees. In Equity Development's research, we highlight that the money manager fees are less than 20% of revenue. Based on the overall revenue margin of 0.69%, this suggests that money manager costs are around 0.14%. Gets a little bit detailed. And whilst you don't itemize out the component parts of the value chain between the platform charge and investment fees, they think that means you're effectively charging 0.5% on average for the platform. And this is more expensive than Hargreaves Lansdown, who are already viewed as expensive at 0.45, and certainly more expensive than Vanguard and AJ Bell. Do you think there is a risk you'll need to significantly reduce your prices as customers become more aware of the differential in pricing and the impact it has on investment returns over time?
We feel very comfortable in our pricing because of the value that we deliver to customers. If you think about what you get with PensionBee, you get state-of-the-art technology, state-of-the-art customer service, you get global flagship investment products that have been curated and selected by the investment committee of the company. You get ongoing management and the ability to effectively plan for retirement in a very, very streamlined way. And so you get an exceptional value with PensionBee. The way we think about our pricing from a competitive basis is to compare it to the workplace pensions market, where a lot of our customers will be transferring in from. And within the workplace pensions market, there is a charge cap on default funds within the workplace, and that charge cap is at 0.75%. So we are well below the charge cap for the vast majority of the assets that are administered on behalf of our customers. We do have some specialist plans that are more expensive than that, and therefore we see ourselves as being entirely competitive and in line with what the broader market is doing. When we look at the actual distribution of our pricing, what we find is that the majority of our customers are paying between 0.5 and 0.75% on their fees. And that actually compares exceptionally well when you compare what the average customer of any of the personal pension platforms that were mentioned in the question is actually paying.
Okay, thank you. Perhaps I'm leading on from that. Money manager fees increased from 0.1 to 0.12 across H1 to H2 2021. Why was this, and do you expect the money manager fee to continue to increase in the future?
I'm happy to take that. The money manager fees really reflect the distribution of assets within various funds. So each product will have a slightly different underlying fund charge. And the fee will fluctuate in accordance with where the flows go. As a rule of thumb, the funds with the most, sophisticated and actively led type of management tend to have higher underlying fund fees. And so to the extent that fund fees have increased, it's because the flows of our customers' pensions have gone into some of those funds. Overall, however, over the past couple of years, what you can see is, in fact, that fund manager fees in aggregate have been decreasing in total basis points and also as a proportion of revenue.
Okay, thank you. In the accounts, please can you provide more detail on what the management fee and other expenses are? You guide that, well, I'll leave it on the second half and then I'll let you interject. You guide that tech development costs as a percentage of revenue will reduce to 30% in the medium long term, but in the long term, could this percentage reduce even further, say 20%?
Yeah, I'm happy to take this one. So money manager fees, they relate to fees we pay to money manager partners, so BlackRock, Legal & General, and State Street, and they are, as you can imagine, fully variable in nature. In other expenses, those costs relate to typically technology costs, and are and can be thought of from a nature of the cost base perspective in three buckets. So and it's roughly a third. So a third of that cost base is volume related, and that relates to, for instance, KYC checks, etc. A third is people related, and that relates to costs that relate to on a per seat basis, for instance. And then another third is fixed cost in nature. In terms of guidance in the long run, and this ties also a little bit in terms of where we're seeing adjusted EBITDA margin to end up with. So we are guiding towards a medium-term target of 25 to 35%, and then a long-term target of 50% plus. That means that in the long run, we would envisage that we harvest, so to speak, the fruits of the technology platform, which is scalable. So that means as we increase recurring revenue and grow that the cost base would obviously grow as a much lower rate, and that means the EBITDA margin would expand. So to answer your question, so yes, we would expect that the 30% would come down in the long run indeed.
Okay, thank you, helpful. You also talked about preparing to scale to 1 million customers. I suppose sort of leading on from that, are there any major CapEx requirements, projects along the way that you need to get to this size?
No, and the reason for that is that our technology has already been built on cloud-based systems, and so is infinitely scalable. If you look at our registered customer base, as at the end of the year, we stood at 658,000, and that is already well on its way to 1 million, given that each one of those registered customers already has a profile within our technology. So no, we don't really envisage major CapEx expenditure. We do envisage smaller projects, I would say, to keep our code base neat and aligned, and to facilitate future innovation and expansion of product features.
Okay. On to labour demands. There's a lot of fintech scaling quickly at the moment in London, a lot of competition for recruitment. Is that having a detrimental impact on you, and are you seeing significant wage inflation?
We actually embraced the culture of remote working very, very early on in the pandemic. And so in 2020, we told our team that they could work from anywhere in the UK. And as a result of that, we also began hiring anywhere in the UK. And that model lends itself particularly well to hiring engineering talent. So we haven't actually been impacted by the recruiting spiral that has engulfed London. We've been able to hire across the board and across the country, and so have filled our recruiting needs fairly well.
You're doing the levelling up agenda for our politicians.
We are.
Lastly then, just a shout out if anyone's got any more questions. I'm moving on to the last one. What are the implications of moving to the premium segment of the LSE, and will you see any additional costs, and what are the additional benefits?
The implications of moving to the premium segment are incredibly positive for the company. First and foremost, the premium segment is a very strong signal for the care that we place around our corporate governance framework. Already when we listed on the high growth segment, we voluntarily committed to comply with the code. And the move to the premium segment really cements that commitment in a more formalized way. Second, and equally importantly, on the premium segment, we have the opportunity to be included in various index funds. On the high growth segment, we are not included in index funds, but on the premium segment, we would expect to be included at least in the FTSE All Share indices. And so that will, of course, have a positive benefit for the company through the generation of additional demand for our shares.
Lovely. Well, thank you to you both for your time. We are out of questions, and I know we'll probably hear from you again at the end of the next quarter. We look forward to that.
Thank you very much.